Hello and welcome to Options Guide TV. My name is Brian Overby. I am the author of the Options Playbook, and I'll be your host here for about the next half hour. And with that said, if you have any questions about any of the trades that we're going to talk about today, please make a note of that question and put it in that chat box. If you are on the YouTube platform, I will try to address it. It's a very interactive show here on Options Guide TV, and we have a lot to talk about just because we're right in the heart of earnings season. And we did a couple of butterflies this week, some very speculative trades. We started by doing one in Microsoft, and ideally we had Microsoft or we had Google, and we decided to go Microsoft, and we picked the right one out of those two. Very different results after earnings in Microsoft and Google. We came back on Wednesday's show after their announcement on Tuesday, and we looked at how we would close out the Microsoft trade. And what was very interesting about that butterfly, and this is part of the reasons why I like to look at butterflies around earnings, because every butterfly around an earnings report is a PowerPoint presentation on its own as far as pricing is concerned. And what we saw in Microsoft that we chatted about on Wednesday's Options Guide TV is that the market reached our long strike on our out of the money butterfly. And we had in that scenario the fact that we actually doubled on that position. And when we're doing these butterflies, we've always said that if you get more than a doubler, that's great. But whenever you double on any of these trades, you want to think about getting out. It's not a butterfly trade is not a home run trade. It's not buying an out of the money call and you want the stock to go to the moon, or out of the money put and you want the stock to tank. You want the stock to land within a range. You take everything that the marketplace is telling you going into that earnings, and then you try to set up that trade. And I talked a lot about the fact that Microsoft was announcing on a Tuesday. That means you got all day Wednesday, all day Thursday, and all day Friday. There's still a lot of time premium in those option contracts on Wednesday after a Tuesday earnings report. Today we had Amazon, and we looked at, and after we talked about the pricing of that butterfly on Wednesday in Microsoft, we said, okay, now let's do a rinse and repeat, and let's look at the same scenario in Amazon. And on Amazon, the biggest difference is, well, it's a lower price stock at this point in time. Microsoft was, currently Microsoft is at $334, and Amazon is trading at $129. So the total cost of the underlying stock affects the options prices. The more expensive the underlying, the more expensive that at the money option contract is going to be. So that matters. And especially when we're looking at a butterfly around earnings where volatility is pumped up, the higher the implied volatility, usually the cheaper the butterfly. So what do we want to have happen? And I'm going to eventually bring up the options playbook here in a little bit. I'm going to do that. And we highlight in the options playbook what you want to happen after you put the trade on. And in that section, the thing that you want to happen in a butterfly is, first of all, you want the stock to go within the range between the long strike and ideally right in the middle of between the long strike on the call that you bought to try to drive the strategy, and then the long strike on the call that you bought to try to protect the strategy. Now, obviously, you want it to land somewhere in the middle, but anywhere within that range, you're usually doing pretty good on a butterfly. If it does land within that range, then you want implied volatility to come down. And that is the one thing that we can control with earnings. If you could make a bet on anything, is that going into earnings, you're going to bet, and you could bet that, I'll bet you that implied volatility will come off after that earnings report. You're going to win that bet 99% of the time. So those are the two things that's the one aspect of a butterfly that you can control by doing them around earnings. They're still extremely speculative. You still have to get your direction right and get the potential range right. But It is important to note that. All right. So what happened with Amazon? Amazon announced earnings, and they literally blew the numbers away. AWS, what the cloud computing wasn't as good, but everything else around Amazon was extremely good on the numbers, and you needed that to get an update considering what happened with Google. Apple hasn't announced yet. They announced on November 2nd. I think that was what my note was, but I don't have it written down for some reason. And Netflix announced last week and did very well. So very mixed metaphors from the mega cap stocks so far. We also have NVIDIA that's going all the way out to November. They're going to be one of the last stocks of the Magnificent Seven to announce earnings. Okay. So the market came up and also landed very close to the short strike. So this is a great learning opportunity between the Amazon butterfly and the Microsoft butterfly. The Microsoft butterfly more than doubled, but now let's go and take a look at what happened with the Amazon butterfly. So let's pull up the TradeHawk software, and we're looking at the options grid. And I will recap what the strategy was. We went out and we bought, we looked at the expected move, and we made sure that our landing area was somewhere within that expected move. And that was right around, well, now we're up 10, but it was, 7%. Around 7% is what the expected move is. And I'm highlighting right now that we're at 7.5%. Now, I do always want to say we did this on a Wednesday, probably would have waited and done it on a Tuesday closer to the close. But we don't tape Options Guide TV on Tuesday. So we're limited as to when we're going to put these strategies on. But with that said, the market moved down a little bit, but here we are. Market came to 128. This is our strike that we put on. We went 7 points wide. We bought the 128 with the shortest term expiration, only 1 day remaining. Sold the 135, 7 points higher, went another 7 points higher, and bought the 142. We were able to get that trade done for $1.10, and we now see this trading for $1. And markets move $1.75. So we doubled in Microsoft, and the market actually, I think when we were looking at it, just reached the strike. And in this instance, we're up 65 cents. We did not double. It's not $2.20. We did not double. The market is going in the right direction, though. It seems like it's creeping upward. With that said, how come the Microsoft trade rewarded more so than the Amazon trade? The reason why is that the Microsoft trade still had 3 days remaining. So our options, the option that we bought, had a ton of time premium in it. And that time premium, because we didn't land between the strikes by 11 o'clock, Microsoft was there for sure. And you probably would have got out earlier, and you probably would have did better than a double on it. But when we taped the show, the Microsoft was right around that strike. And the position did better than the Amazon. Now, I only mention this because I think it's so important to understand option pricing. And the huge difference is that when we did it in Microsoft and kind of made it, right, we were pretty accurate on our forecast. The time premium helped us out. So if you are kind of right, you want to have some more time premium. If you are exactly right and it came all the way up to your short strike, you do not want any time premium. And so in this instance, we only have 1 day remaining in Amazon. We only have Friday to trade. So guess what? We didn't do as well. That's simple. If Amazon continues on up, we have a 7 point wide strike. This time value is already gone. Notice that. This is no risk anymore to us. So every point that it goes up, as we get deeper in the money, this delta is going to skyrocket, and it's going to get to 1 very quickly. So as we move deeper in the money with 1 day remaining on these option contracts, this delta will get moved 1-to-1 with the stock. And so in this instance, if we were to let this ride a little more, because we thought we were going to be bullish on it, or we thought we were going to turn out all right, we would get rewarded for that. If we were correct, we would get rewarded very well. Whereas we would have got less rewarded on the Microsoft situation. Why? There was still a lot of time premium, and that explosive delta, which is actually called gamma, which drives that, that explosive delta just isn't there as much as it's going to be in this Amazon scenario. So two perfect scenarios to learn on Options Guide TV. We couldn't parse this out better if we tried, and we're using real-time data. So what do we do with this trade? I probably would have sold a little bit on the open. My Amazon did open higher than it is right now. Right now it's up $9.76. I think it got close to 131. I don't want to run over the charts right now because I got those all set up for the next trade that we're going to talk about. But with that said, I would just close this trade out. We're at 160. We made 50 cents on the trade. Our goal would have been to make 110, right? Sell it for about $2.20. Might have been able to do that this morning. You could just close out. You have the short spread. This is worthless. The option that we bought is worthless. They don't really give you a lot of risk. But I guess I'll just put it in and close the butterfly. So 175. I'm going to leave it at 175. We're trading right close to that. Now we're up to 180. Now it's up 10. Yeah, it's interesting to hang long in this trade, but very rarely do I do a trade totally based on earnings and hang on to that trade all the way to the expiration, all the way to the close on Friday. Usually I'm out by noon. 10:30 and noon, 10:30 and noon Eastern time is usually when I'd want to exit that trade. Okay, so simply all you do, you have this one's buy to open. I can't say close, but it should be because it just won't let me. I don't have the real position on. This would be a buy to close, and this would be a sell to close. And then notice this becomes a net credit. We'll do it right at 175. And we had two speculative butterflies that panned out just fine this week. So 2 thumbs up on the paper trades. And if you have any questions on them, please make sure you put them in the chat box on YouTube, and I'll try to address it. We can address this trade. It was a great learning experience as far as option pricing is concerned. So next, we're going to go in and look at a long straddle. Talk a little bit about the market. So let me go, and I think at this point in time, I'm going to move over to the options playbook. So let's jump out here. 1 second. Thank you. And then let me bring this down, and I am going to pull up the options playbook. So here's my book. Let's share this. So this is a long call spread with long butterfly spread with calls. And we showed this and went in great detail about the profit and loss graph. Now, what we're going to do today is we're going to flip this. I've been threatening to do a long straddle. Now watch what happens. We flip that upside down, and now the point is right in the middle and going on up. So if you are excited about, you want to get somebody excited about options, the long straddle is a great thing to talk about, because all you have to say is, do you ever have problems picking directions on stocks in the short term? And almost everybody will say yes. Well, how about I tell you a strategy that can make money if the stock goes up or down? Well, there you go. That strategy is a long straddle, and that will get somebody excited that just trades stocks. Downside is the marketplace knows that the market can go way up and down. So the more potential for it to move, the more you have to pay. And the further this V comes down and the further out on the x-axis does the profit and loss graph happen. So I don't do a lot of long straddles. As a matter of fact, the math, if you want to get into the math of the market, And the way options are priced, 7 out of 10 long straddles don't make money. Just the way that options are priced in general. So when you win, you got to really win, because most of the time you lose. It's just that simple. It's much different than doing out of the money short spreads, where most of the time you win, but you win a little. And when you lose big. So long straddles are hard for beginning investors to do, because they get a profit and they want to get out. And then when they have the loss, they hold on too long. It's the quintessential strategy that beginning traders screw up, because they follow their emotions way too much. Okay. So with that said, we're still going to do one today. I threatened to do one in the SPY, but I missed it. I missed the move. Would have done well. We talked right around the 4,200 area. We mentioned it many times on Options Guy TV that was a strong support area in the SPY, and we've already moved down below it. VIX was trading right around 17 or 18. The VIX is a little too high to do this trade today, but I'm still going to put it on. It's a paper trade. Like I said, I can't pick all the moments that we tape Options Guy TV. So we're still going to do it. I still don't mind the trade, even though the volatility index, the VIX, is up above 10%, but I'm not going to use the SPY. All right. So that's going to be the trade. Now, I want to show you the CME FedWatch tool. I want to talk a little bit about this. Now, this was interesting in that prior to the Fed speaking a month or so ago, their comments that they had, the November meeting that's coming up here on November 1st, there was the current rate is here, 525 by 550 on the Fed funds rate. And they gave a probability. There was a bar over here saying there was a 40% chance that they were going to raise it by a quarter. Now, that probability is gone. There's no probability according to the futures market. This is the CME futures market where the futures trade. And according to the futures, there's no chance. And all of a sudden, there's a little blip that they might lower it a little bit. It's less than 1%. I just thought it was kind of funny that this showed up. And I wanted to show how to use this tool. Now, you can go out to December. All you do is click on this. Actually, we can go down here. Here was the current rate. Here's where it was at a month ago. It was at 22% chance of a quarter point hike 1 month ago. And see, this was the current rate. This is the quarter point hike. This is where the probability was a month ago. Here's where the probability is now. It's at 0. So if we go to December, the December meeting, those future contracts still trade, obviously. So now they're still saying that there is a 20% probability that they would hike in December. So that possibility is still there. Really hope they don't. I think they need to let everything filter through the economy and see where the rate hikes are at. A lot of people are making the argument that the 10-year just bumping up against the 5% range has really done the Fed's work for them. But that also kind of anticipates the fact that the marketplace is showing their hand that way. That's part of the reason why we're still seeing a higher or a decent probability. 20% is a decent probability that they will raise it by a quarter of a point. All right. And we still have some massive earnings coming out. We're just got rocking and rolling into earnings season. So I thought I'd bring up this chart. I want to show you that Apple, this is Thursday. This is Earnings Whispers. Give them credit where credit's due. This is a great chart that they put out on Twitter, usually on Fridays for the next week's earnings. Here's Thursday. This shows you before the open. This is after the close. And here's the big one. This is Apple that's announcing. I think it'll be interesting. What was the other one that I saw? Carvana is in here somewhere. I don't see it right now. But Carvana is going to be announcing earnings, and they've been struggling. So it'd be really interesting to see where their earnings come in at. And then we have this morning, we actually had ExxonMobil announce earnings. Stock actually was up just a little bit after their earnings announcement, and that was most energy companies announced before the open. We have PayPal after the close on Wednesday. That's been a struggling stock. Can't really figure out why they can't figure things out. And then another one that's interesting is Caterpillar. So next week, we'll definitely look at a trade in Apple going into the Friday. So once again, you're going to have the Thursday situation after the close. One day to trade is on Friday. And interesting enough, the SIBO is going to be announcing earnings on Friday, and I will be at the Chicago Board Option Exchange, which is now SIBO Global Markets, on that Friday, actually visiting my old stomping grounds from back in the day when I lived in Chicago. All right. All that said, we got a few more minutes. Let's go and look at look at our strategy. Let's look at our long straddle. So very interesting chart. So I'm going to show you the trade that we missed. Basically, I had all the intentions in the world of doing a long straddle in the SPY or the SPX. We probably would have did the SPY because we can do that on the paper trading app. But if I pull up the chart, here was the SPY. We talked about the 420 level right here. There was a lot of noise. The 200-day moving average was here. There's a little bit of a gap down in this chart. This area just all the way across just as interesting in the SPY, right at that 420 level. And that's where are we going to bounce off of the 200-day moving average? Is it going to provide that support, or are we going to break down? And we ended up breaking down. It battled. If I zoom in a little bit more, let me grab this chart here. And you just see that it hung and it hung and it hung until it didn't, and then it confirmed the move to the downside. So right now the market, as far as the chart is concerned, is scary. The SPX market is trying to establish where it wants to go next. Would have been nice to be long our straddle or long our put at this point in time. Probably would have paid out. The market definitely made a fairly strong move to the downside since we started talking about this. But I think a more interesting chart now is the IWM. This is the Russell 2000 index, and this market has really struggled. But look at what's happened here in the Russell 2000 index. We're going out a couple of years. Let's go out 800 days here. Let's change this one up a little bit. And see the huge drop that we had from 2021. This market has just really struggled. Here was a big gap down, coming all the way down to this range. And now we've tested, this will be the third time that we're testing this level right around here at 164. Even more profound of a chart than we saw in the SPX. And everybody was talking about the 4,200 level. So also bigger moves too, right? From this point, you're looking at 200 all the way down, let's call it 160, just to make the math simple. That's a 50-point move in the Russell 2000. So more propensity to move. That means we're going to have more risk because it's higher volatility. We're going to have to pay for it. Like I said, vol is up. I prefer that volatility was down a little bit, but we're in a down market and we're just sitting right here. And the Russell 2000 is trying to figure out where it's going to go next. So as always, total speculative trade, not meant to be a recommendation, but this would be a time I'd be interested. There's a lot of geopolitical concerns, obviously, that are getting figured out. We're still in October. Recession fears are still around the corner. Earnings are mixed. The 10-year's bumping up against the 5% range. So there you go. Let's look at a trade. Let's look at a trade in the Russell 2000. I'm going to pull up the markets here, see where we're going. The 10-year right now is 4.85%. That's where the interest rate is at. And here is the Russell. So obviously don't want to do a near-term trade on this. And this is going to be a fairly expensive trade, even though we're going to do a one-by-one long straddle we're going to be looking at here. So we're going to go out. I'm going to go out to the normal expiration, which is November 21st. November 21st, that should be a Friday. And let me confirm. November 21st. 1st. Yep, that is a Friday. So this is the normal monthly expiration. The market is at 163.60. I like it to be right at a strike, but it's not. It's in between these two strikes, but they're 1-point strikes, so not that big of a deal. But with that expiration, oh, stay there. Okay, highlighting that we're in that expiration. My bid and ask moved on me. When did that happen? All right. And we now see this trading. Let's add it here. Let's click once for buy. Go here, click once for buy, and that is our long straddle. That's simple. So 7 points is our expected move. That's going to be about 5%, maybe a little bit more. Let's see. So now that would be a real big move in the SPY over that time frame, but this is IWM. You saw the 50-point move that we just came down from. That took probably longer than 21 days to get there, but the propensity for the IWM to move, and these are all the small cap stocks, is much higher. So 735 divided by 163.55 equals 4.5. 4.5 is a 7-point move, and it's about a 4.5. Yeah, I said 5%, didn't I? Even better. 4.5, we'll call it. We'll round it off. So a 4.5% move is what we're looking for in IWM, and we're hoping to get that move before November. I have no problem legging out of this trade. If you get one side of the trade to pay off what you paid for it, and you can quote unquote play with the house's money, I guess, I'm okay with that. I'd normally, if the put is trading right now, it's at $3.65 on the put side. If we got to move to the downside and I saw this trading for $10, no problem taking that put off, trying to do something with the call. This is a trade that I am definitely going to adjust. I very rarely will just put it all on as a long straddle and take it all off as a long straddle. And there aren't many opportunities to talk about long straddles. The one time I don't want to do a long straddle is usually around earnings. I don't want to deal with earnings. I want to deal with charts that are showing me that we're on a precipice, looking for either a big bounce off the chart to the upside or the downside and not really sure which way you're going to go. If you wanted to, from looking at that chart, if you do think it can bounce the third time, it can actually bounce and go back up. That's a strong sign for the Russell 2000. Well, go ahead and buy some calls. I mean, it's that simple. The market is at an interesting place, but implied volatility is high. So we're going to put this on, give us some time, and we do have $735 of risk plus commission to put that trade on. All right, and I look at the clock. We're right at time. I do not see any questions in the chat box. And that's going to be it for another. I'd say this was a fun week of Options Guide TV. Please click subscribe if you're in the YouTube platform and ring that bell. You get all the alerts for Options Guide TV. And then pound that thumbs up and share this. Share this on social media. Share this everywhere. We want to drive people to Options Guide TV so that we can start building out the conversations. And once we get there, we'll start doing some just ask the options guy what you'd like to know and try to address those. Those are some of my favorite episodes to do overall on podcasts, on webinars, is just being able to interact with people out there that have questions about option trading. So that's it. And we'll come back this Monday for the next edition of Options Guide TV. Thanks for coming, everyone.